A good thing, Dennis. All right, and more firms are now looking to spend this cash on housing. Meet your new landlords. Private equity and hedge funds are buying up single-family homes in a total frenzy. Greg Rand of Own America says this is the most significant housing trend in decades. He joins us now to explain, on one hand, this is what we want, right? We want private companies buying houses. We don't want government interference. Involvement.
Exactly right.
The flip side, though, Blackstone's buying houses. Are they my new landlord?
Well, they could be. It's a pretty big trend because you're talking about billions of dollars right now and many billions more being raised to come into the single-family rental market, never have before.
Right.
And so the upside of it is that what we need, any sluggish marketplace needs more demand to create upward pressure on prices. We want a stabilized housing market. When you have billions of dollars of new demand that have never even tried to buy single-family homes before, that only means good things for stabilization. But the risk is sometimes institutions in the housing market have a negative effect. We've seen that happen over the last 10 years. So if they oversaturate some cities, they could mess them up.
Right, and there's a lot of risk for screw-up here, too, as well. So. But let's backtrack a little bit, because part of the reason that these hedge funds are diving in themselves is, originally, we thought this was going to happen through Fannie Mae and Freddie Mac, didn't we?
That's right.
And they're so backlogged, they can't do it.
That's right. The funds that have raised the capital had a plan to go and buy in bulk from Fannie, Freddie, and some of the big banks. And because of various things, including lawsuits from the federal government and state governments, the logjam of foreclosures is now not coming to market. And so they're seeking alternative ways of assembling portfolios, which is what we do, assembling portfolios of single-family assets for these funds. And that's actually a good thing. Because if you have a city, pick a city like Las Vegas that has a lot of foreclosure activity, too much housing was built, not enough people to live in them, drove home prices down. If Fannie and Freddie and the banks sell all those properties now to funds who then turn them over as rentals, the same exact thing is going to happen. You don't have enough people there, and so it's institution going bad, handing off the hot potato to the next institution. So when you build a portfolio of properties all across the country, you can spread out the risk geographically, and that makes a big difference.
But, okay, so you represent about 3 funds that are going out and buying these single-family homes.
That's right.
So that's what you're telling them, I presume, spread your risk.
Right.
But are you also telling them, go hire, construction managers? Because you're buying up properties that have been totally some of them have been destroyed.
It's interesting. One of the things that we recommend is don't buy the stuff that needs rehabbing. Okay? There are plenty of lovely single-family homes out there that are sitting on the market that represent fantastic investments in cities that, because of the downward trend in pricing over the last 5 years and the upward pressure on rental rates because of all these new rental households, there are cities across this country that were never able to generate a positive cash flow on the rents that now can.
I have to run quickly, though. The rents are starting to go up. Aren't we going to hit a point where people are saying, I don't want to rent anymore, and then this could backfire?
I don't think backfire, but I think we could see an oversupply of rentals, which could then reverse that trend, which would be good for the tenants.
Right.
But it means that the investors have to be cautious about how their expectations are of rent rise.
And how much they're buying. Greg Rand, that's great stuff.